Okay, so you want to own a waste management company. Every house, every apartment, every restaurant, every office building, every hospital, every factory produces trash every single day. And someone has to come pick it up. That someone gets paid whether the economy's growing or shrinking, whether people are spending freely or cutting back, whether the stock market is climbing or collapsing. Garbage doesn't stop being produced because interest rates went up. Nobody cancels their trash pickup because they're having a tough quarter. The demand is as close to guaranteed as demand gets in any business on Earth. Here's what that description leaves out. The reason waste management looks like a guaranteed income business is the same reason the two largest waste management companies in America, companies most people couldn't name off the top of their head, have quietly become two of the most valuable infrastructure businesses on the continent. And the same reason a new competitor trying to take their routes has almost no chance of succeeding. Not because the incumbents are better operators, but because of something about the physical economics of this business that makes it nearly impossible to compete with once someone has established themselves in a market. Let's start with what you're actually buying, because a waste management company is not one business. It is at minimum 3 separate businesses operating in a chain, and owning only one link of that chain puts you at a significant disadvantage against operators who own all 3. There's the collection business, the trucks that drive routes and pick up bins from homes and businesses. There's the transfer station business, the intermediate facilities where collected waste gets consolidated and sorted before being sent to its final destination. And there's the disposal business, the landfills or processing facilities where waste is ultimately handled. Each of these businesses has a different cost structure, a different regulatory environment, and a different competitive dynamic. But the operators who own all 3, a structure the industry calls vertical integration, have a structural cost advantage over operators who own only 1 or 2 of the links that compounds year after year. Here's the economic concept that explains everything about how the largest waste companies have built their market positions, and it's a concept called route density. A garbage truck driving a collection route has roughly the same fixed cost whether it picks up 50 stops or 100 stops along the same road. The truck costs the same to own, insure, and maintain. The driver earns the same wage. The fuel burns at roughly the same rate. The only variable is how many stops are on the route and how many pounds of waste gets collected at each stop. When you own the majority of the collection stops on a given road or in a given neighborhood, your cost per stop falls significantly compared to a competitor trying to serve a scattered handful of stops across the same geography. This is route density, and it is the single most powerful competitive advantage in the collection business. It is also the reason that once a collection company dominates a market, it becomes extraordinarily difficult for a competitor to undercut them on price. The dominant operator can price low enough to retain customers while still making a margin because their cost per stop is low. The challenger is paying the same truck, driver, and fuel cost to serve far fewer stops, which means their cost per stop is much higher, which means they either lose money serving those stops or have to charge more than the incumbent, which means they don't get the stops in the first place. Before a single truck rolls, there's the matter of getting the equipment. And this is where the capital requirements of the collection business surprise most people looking at it from the outside. A modern rear-loading residential garbage truck costs somewhere between $250,000 and $350,000 new. A front-loading commercial truck that services dumpsters at businesses and apartment complexes runs somewhat higher. A specialized roll-off truck that hauls large construction and demolition containers can run higher still. A small collection operation serving a single municipal contract might need a fleet of 5 to 15 trucks as a starting point, which means the equipment investment alone before a single route is run can be $1.5 to $5 million. And trucks in this business wear out. They're being loaded with heavy material, compacting it, driving it potentially dozens of miles to a transfer station or landfill, and doing this every working day of the year. A typical garbage truck has an operational life of somewhere between 8 and 12 years before major refurbishment or replacement is required. For a growing operation, the capital expenditure requirement for the fleet is not a one-time event. It is a recurring, permanent feature of the business that must be funded out of operating cash flow or financed. Then there's the municipal contract, and this is where waste management economics become genuinely interesting. The majority of residential collection in the United States is handled under exclusive contracts between collection companies and local governments. A municipality, whether a city, a county, or a special district, puts its residential collection service out to bid, typically every 5 to 10 years. The winning bidder gets the exclusive right to service every home in that jurisdiction for the contract period. Nobody else can compete for those customers. The homeowner cannot choose a different hauler even if they wanted to. The municipality has made the choice for them. This exclusivity is enormously valuable for the winning contractor and enormously frustrating for anyone trying to break into a market that is already contracted. A company that wins a municipal contract for a mid-sized city of 50,000 homes has essentially locked in the revenue from those 50,000 stops for the next 5 to 10 years, subject to the contract's price adjustment clauses. Those adjustment clauses are worth understanding in detail because they determine whether a contract that looks profitable on bid day is still profitable in year 7. Most municipal contracts include provisions for annual price adjustments tied to specific indices, typically some combination of a fuel cost index, a labor cost index, and a general inflation measure like the consumer price index. The contract might specify, for example, that the per-home monthly rate adjusts annually by a formula that weights fuel costs at 40%, labor at 40%, and CPI at 20%. In years when fuel and labor costs rise faster than the formula allows, the contractor absorbs the difference between actual cost increases and the contractually permitted rate adjustment. In years when fuel costs fall sharply, the contractor benefits. Managing the gap between actual cost inflation and contractual price adjustment is one of the primary financial disciplines of running a municipal collection operation. Now let's talk about the landfill, because it is the most strategically valuable and most capital-intensive asset in the entire waste management industry. And understanding landfill economics explains why the largest waste companies are so difficult to compete with. A landfill is not simply a piece of land where you dump garbage. It is an engineered infrastructure asset that requires regulatory permits, liner systems to prevent groundwater contamination, leachate collection systems, gas capture systems for the methane produced by decomposing waste, extensive environmental monitoring, and a long-term closure and post-closure maintenance obligation that continues for decades after the last load of waste is accepted. Permitting a new landfill is one of the most difficult regulatory processes in American environmental law. The permitting timeline from initial application to first waste acceptance can run 5 to 10 years, and many applications are denied or abandoned before completion due to community opposition, regulatory requirements, or geological limitations. The result is that in most regions of the country, the number of permitted landfills is fixed or declining, and building new capacity is extremely difficult. This creates the most powerful dynamic in waste management economics. Landfill airspace is a finite, irreplaceable asset with an extraordinarily high barrier to replication. Every ton of waste accepted into a landfill consumes a portion of its total permitted capacity, called airspace. When the airspace is full, the landfill closes. The owner cannot simply buy more. They have to go through the same multi-year permitting process to open a new cell or a new site, if they can even find a suitable location that will survive regulatory and community scrutiny. For the large integrated waste companies that own significant landfill capacity across their operating regions, this airspace is carried on their balance sheets as a long-term asset that gets depleted as waste is accepted, in much the same way that an oil company carries proven reserves as a depleting asset. And just as an oil company with large proven reserves has a structural advantage over one without them, a waste management company that controls landfill airspace in a region has a structural advantage that collection-only competitors simply cannot overcome. The financial consequence of this is what the industry calls the disposal fee, or gate rate, the amount charged per ton of waste accepted at a landfill. Gate rates vary significantly by region based on how much permitted disposal capacity exists relative to the amount of waste being generated. In regions with abundant landfill capacity and easy permitting, gate rates tend to be lower. In densely populated regions where permitting is nearly impossible, landfill capacity is scarce and gate rates can be substantial. In parts of the northeastern United States, for example, where new landfill permitting is extremely difficult and many states export significant volumes of waste to other regions, disposal costs have historically run significantly higher than in regions with more available capacity. For an integrated waste company, the disposal fee generates profit twice. First, the company charges a disposal fee to third-party haulers who bring waste to the landfill from outside the company's own collection network. Second, when the company's own collection trucks bring waste to its own landfill, the disposal cost stays within the corporate structure rather than flowing to a competitor. The company is essentially paying a disposal fee to itself, and the margin that would otherwise leave the business stays internal. This intercompany transfer pricing dynamic is one of the primary reasons integrated waste companies have structurally higher margins than collection-only operators. Let's talk about the cost structure of running the collection business day to day, because it is more complex than it appears, and the variables that drive profitability are often ones that operators cannot fully control. Fuel is the largest and most volatile operating expense for a collection fleet. A diesel price swing of $1 per gallon across a fleet of 50 trucks, driving an average of 100 miles per day at 10 miles per gallon means 500 additional gallons of fuel consumed per working day, or roughly $500 per dollar of diesel price movement per working day, which across 250 working days per year is a $125,000 annual swing per dollar of diesel price movement per truck. For a mid-sized operator running 50 trucks, a $2 per gallon increase in diesel prices that is not fully recovered through contractual fuel surcharges can cost over $12 million annually. This is not a theoretical risk. Diesel prices have moved by more than $2 per gallon within single calendar years multiple times in the past 2 decades. Labor is the second major variable, and it has become increasingly difficult to manage. Commercial drivers with the commercial driver's license required to operate a garbage truck are in demand across every sector of the transportation and logistics industry. The combination of an aging driver workforce, years of underinvestment in CDL training programs, and intense competition for qualified drivers from e-commerce logistics operators has created chronic driver shortages in many markets. When a collection company cannot find enough drivers, routes don't get covered. Customers complain. Municipal contracts include service-level requirements, and missing too many pickups can trigger financial penalties or contract termination. Paying above-market wages to attract and retain drivers raises operating costs. The labor market for CDL drivers has become one of the primary operational risks in the collection business. Now let's address recycling, because no discussion of waste management economics is complete without it, and the economics of recycling are almost exactly the opposite of what most people assume. For most of the history of modern curbside recycling programs, collected recyclables had positive commodity value. Paper, cardboard, aluminum, and certain plastics could be sold to processors, who converted them into raw material inputs for manufacturing. Collection companies would often charge municipalities reduced rates or even receive a revenue share from recyclable commodity sales, and the system appeared to function as a genuine closed loop. And in 2018, China, which had been the dominant buyer of much of the world's collected recyclables, implemented what became known as the National Sword Policy, dramatically restricting the types and contamination levels of recyclable materials it would accept. Overnight, the commodity value of mixed recyclables collapsed. Materials that had previously been worth $50 per ton suddenly had negative value, meaning processors were charging collection companies to take them rather than paying for them. Municipalities and haulers that had built financial models around recyclable commodity revenue were suddenly absorbing costs they had not budgeted for. The result was widespread renegotiation of recycling contracts, increases in recycling surcharges charged to customers, and in some cases, the suspension of recycling programs entirely in smaller communities that could not absorb the economics. The lasting lesson of the China sword disruption is that recycling, despite its environmental value, is a commodity business subject to global market forces entirely outside the control of the collection company. When commodity markets are strong, recycling can be a meaningful revenue contributor. When they are weak, it is a cost center. Building a waste management business that depends on favorable recyclable commodity prices is building a business that depends on a variable you cannot control or hedge effectively. Let's now run the real math on a mid-sized regional waste management company, the way an operator actually has to think about it. Take a hypothetical company operating in a single metropolitan market with a mix of residential municipal contracts covering roughly 100,000 homes, commercial collection serving approximately 2,000 business accounts, and partial ownership of a regional transfer station. The company does not own a landfill and disposes of its collected waste through a mix of third-party landfill contracts and transfer station throughput fees. In a strong year, residential collection revenue at an average monthly rate of $30 per home generates $36 million annually. Commercial collection at an average of $300 per month per account generates another $7.2 million. Transfer station throughput fees from third-party haulers add another $2 to $3 million in revenue. Total gross revenue in a strong year lands somewhere around $45 to $46 million. Against that revenue, subtract fuel costs at roughly 10 to 15% of revenue, depending on diesel prices and fleet efficiency. Subtract driver labor and benefits at another 25 to 30%. Subtract vehicle maintenance, insurance, disposal fees paid to third-party landfills, and administrative overhead. What remains in a well-run year is operating income of somewhere between 15 and 20% of revenue, or roughly $7 to $9 million on $45 million in revenue. Against a business that might have cost $30 to $40 million to build or acquire, including fleet, facilities, and the value of contracts, that is a cash-on-cash return of somewhere between 18 and 30% in a genuinely good year. Now, the bad year. Diesel prices spike $2 per gallon above budget, consuming an additional $3 to $4 million of operating cash flow that the company's municipal contracts only partially offset through fuel surcharges. A competing operator undercuts the company's bid on a municipal contract renewal, losing 20,000 residential stops that represented $8 million in annual revenue. Replacing that revenue requires winning new commercial accounts, which takes time, and marketing spend the budget did not anticipate. Meanwhile, the recyclable commodity market weakens, turning the company's recycling program from a modest revenue contributor into a cost center requiring an unbudgeted $200,000 annual subsidy. 2 experienced drivers leave for higher-paying positions at a regional logistics company, and finding replacements takes 4 months, during which the company runs overtime and misses service-level targets on 2 separate occasions, triggering a penalty clause in the municipal contract. The difference between the good year and the bad year for this exact company, same trucks, same routes, same facilities, can be the difference between $9 million in operating income and $3 million. A swing of $6 million, driven almost entirely by fuel prices, contract retention, and labor market conditions, none of which the operator controls. So does owning a waste management company actually work as a business? The honest answer is that it works extraordinarily well for the operators who have built vertically integrated platforms with owned landfill capacity, dense collection routes in defensible markets, and long-term municipal contracts with reasonable price adjustment mechanisms. Waste Management Inc. and Republic Services, the 2 largest operators in the United States, have collectively produced decades of consistent revenue growth, strong free cash flow, and market capitalizations that reflect the durability and scarcity of their asset base. They are not glamorous businesses. They are not businesses most people think about when they think about durable infrastructure. But in terms of competitive moat, pricing power, and recession resistance, they have quietly built something that most businesses in America cannot replicate. For a smaller independent operator without owned landfill capacity, without dominant route density in their markets, and without the scale to absorb fuel and labor volatility, the business is genuinely harder. Not impossible, but harder. The margins are thinner, the contract renewal risk is more acute, and the capital requirements of maintaining a competitive fleet are a larger percentage of the revenue base. A waste management company isn't really a truck business or a garbage business, even though the trucks and the garbage are the only parts of it most people ever see. It is a logistics and infrastructure business where the scarcest asset isn't the equipment or the contracts or even the routes. It's the permitted capacity to dispose of the waste once it's been collected. And whoever controls that capacity in a region controls the economics of everything upstream from it. The truck on your street every Tuesday morning is the visible end of a supply chain. The landfill at the other end of it is where the real business actually lives.